Hello, I'm Michelle Makori, and you are watching Kitco News coming to you from New York. 2023 is going to be the worst year for stocks and the economy since 2008, 2001, and 1973. That is the very dire forecast of my next guest, Harry Dent. Harry is the founder of HS Dent, known as the contrarian's contrarian. He has over 4 decades of experience in forecasting. And his correct calls include the 1989 Japanese housing crash, the dot-com bubble, and President Donald Trump's victory in 2016. He's also a best-selling author and economist, and it is very good to have him back on the show. Welcome back, Harry. Nice to see you.
Yeah, nice to be back, Michelle.
Harry, always a pleasure, and I had the pleasure of speaking to you twice in 2022. In January of 22, we spoke right after the S&P 500 hit a new all-time high on January 4th. And you said we are not going to get another high for several years and that the market had peaked. Now, so far you've been correct on that one. You also said that 2022 is going to be the worst year for US equities in history. Now, granted, the S&P 500 did have a tough year in 2022. The index was down around 19.4%, not the worst year in history. It was the worst year since 2008, when the S&P had a decline of around 38.5%. Now, you also said that everything was going down in 2022, that this was the everything bubble. Energy, however, was on the up. It was the only positive sector for the year, up around 59%. Now, firstly, Harry, let me just say that I applaud anyone that actually sticks his neck out there, gives a specific prediction and a timeline. And you always do that, so credit to you there. Now, again, we spoke in May, and again, you reiterated that this everything bubble was going to burst, that everything was going to go down, all stocks, all crypto, all coming crashing down. That's only been partly true, as we just touched on. Energy was a good performing sector. Since May, the S&P has fallen by only about 3.5%, give and take on the day. The crypto sector at large did shave off almost $1 trillion in market cap, falling by around 45%. Now, the magnitude of your predictions did not quite turn out as expected. You said you were expecting a 40% decline in stocks in 2022, and then a gradual decline down to 86% from the S&P all-time high in 2021. Now, again, to be clear, I fully respect you for having the gumption to give non-vague answers and forecasts that are specific. And to be fair, you did say that these crashes are going to come in waves, and your timeline for the overall crash is over a 2-year period, give or take. So yes, 2022 was brutal. You correctly said no new highs, but it wasn't quite as brutal, quite as ugly as you expected. So why do you think that is? What do you think prevented a more severe crash from happening in 2022?
Well, first of all, the index I track the most, especially in these times, the NASDAQ has been down 38%. And one of the things I look for, I had to study bubbles because my early research was more about demographics. When did generations spend more, and why we were going to see the greatest boom in history, because the baby boom was such a large generation. But bubbles have their own logic, and they usually last about 5 years, and then they crash twice as fast. But the only way especially since the government has been pushing this and pushing it every time there's a slowdown or the markets crash at all, they just stimulate harder. So they've been feeding this bubble. You don't know if bubbles really crash until you get about a 30 to 40% first crash. So that's why it was critical to me when finally in 2022, the NASDAQ, which is the lead major index for me, was down 34% and then ended up with a new low after that, down 38%. That told me, and I could finally say to my subscribers, look, this bubble has finally burst. It has started to burst. Now, a bubble of this magnitude, like 1929 or like 1972, which was not a bubble, but it was a long-term peak, okay? I mean, it takes about 2.5, 3 years for the whole crash to happen, okay? So all we've seen so far, and we have seen it, that first crash, like you said, the S&P was down, 20-some% at its worst, and NASDAQ down 38% at its worst. And then it looks like to me we're in the next wave down. We've been going more sideways since June of 2022. And it looks like to me we're starting the next wave down. The next wave down is what's going to really say that something different is happening. This is not a correction. And I think we are in that next wave starting in the next so many months. We'll see that. That'll take us down. We'll be down 50 to 60% in things like the NASDAQ and the S&P 500. And now you'll know this is not a correction. This is a major crash. So we're still in the process. I feel like the ultimate low at this point for stocks is likely to be, if I had to pick a day, I'd say it's like summer, like July or so, 2024. So we're still in the early stages, and we still have, and I need a confirmation at this point to know that this crash is continuing and will go a lot deeper. We need to break the last low, which again, I'm tracking the NASDAQ as my number one index, 10,088. Now we bounced, that was the last low. We bounced from there, and we're about 8% above that now, but it would not take long to get there. We break that 10,088, and that's when we'll see the next wave confirmed, and it should get nasty pretty quick after that. And then we'll be deep into something we have not seen since 2000, 2002, and some of those other previous crashes we talked before. So it is happening. Now, why does this not happen? Governments are fighting this with everything they've got. There is never, the Great Depression only saw a little bit of stimulus. Once we got down so low in early 2009, the Federal Reserve and central banks around the world just pulled out the guns. They've been stimulating in higher and higher amounts, $10 trillion just since COVID, okay, before they started to tighten. And finally, that's when they finally blew it. They were stimulating steadily enough to get away with it, but when they panicked on COVID, $5 trillion in monetary and then $5 trillion in fiscal, and fiscal is far more potent to inflation. Then all of a sudden we get this 9.1% inflation when we've been scraping 1% to 2%, which again, my forecast said way back in the 80s, we would go down to near zero inflation because of the slower and slower workforce growth is slowing in our economy. So that's where we're at. They've been fighting this since 2009, stimulating more and more. But since where they blew it, even in that stupid strategy, from my point of view, that has to fail because you can't live on stimulus forever, they overdid it in COVID and they were forced to tighten. And now that they're tightening into an economy that, from my measurements, I've got the best fundamental indicator I've ever seen in history, and I'd love to see somebody challenge it. This whole 46-year lag for peak spending that shows when generations are going to spend more, like the Bob Hope generation, 42 to 68, baby boom 83 to 2007, and why we went into a slowdown in 2008, and why it took so much stimulus, and we still, every time they pull back, we go down. We're still in a weak period until 2024 when the millennials come along. So I think that this tightening is going to cause the economy and stocks to react faster than they think, and they're going to be now behind the eight ball and turning around, and everybody's looking for a pivot. They can't just turn around and pivot on a dime.
Let's start unpack some of what you said there, because you've made a couple of great points that I do want to dive deeper into. So firstly, the NASDAQ is down around 31%, give or take, since its all-time high.
38% at worst, and that's I can guarantee on that. 38% was what it was at worst. The 10,088 was the low.
And it's down, 10.8% since we last spoke in May. Now, why the NASDAQ as opposed to the S&P 500? Why is that your overall metric for where the market and the economy is going at large?
Well, the NASDAQ is more volatile. It's more the tech stocks, the more aggressive stocks. So it's going to go up more when it goes up, and it's going to go down faster. And in the S&P 500, it's almost like when things start to look questionable, like in the last year, people say, okay, well, I'm not going to get out of stocks altogether, although, of course, I've been advising that for a while. They'll get into safer. So the S&P 500 is seen as more stable as the NASDAQ. So the NASDAQ and the Russell 2000 small caps are the more volatile indexes, which go up the most and go down the most. And that's why I'm tracking the NASDAQ. The NASDAQ is the lead index here that's leading the way, and the S&P follows. And in the end, they'll all be down 80% or more. But the NASDAQ has been leading this crash, and that's what you would expect.
So let's talk a little bit about what you are forecasting specifically. In your latest newsletter, you write that you predict a crash of as much as 86% on the S&P 500 by mid-2024 or so, and 92% on the NASDAQ. Now, just to be clear, is that a further 86% down from
the
here
top,
or from the total
from the
all-time
high?
Okay.
The all-time high was November 22nd on the NASDAQ and January 4th of 2022, just after that on the S&P 500. And let me just make this clear. All this is going back to the early 2009 lows of the last major crash, okay, after 2007, 2008 crisis. It's not erasing all the gains and all the bubbles and stuff before. It's just going back to the last lows. And I have a similar forecast for housing. Housing is just going to go back to its 2012 lows. Housing takes longer to correct. It took 6 years from top to bottom. It peaked before stocks the last time, way after. It's just going to go back to 2012. But you know what that is for the average house? 50%. That's how big a bubble we've had in housing. So that's what I mean by everything bubble. Commodities, gold is bubbled. Gold has gone up more than stocks at the best. So everything goes down. Stocks, real estate, commodities. Commodities have gone down the most first. Gold is holding up because it's seen as a safe haven until things failed. Same thing happened in 2008. But stocks are the lead now, and that's why I'm focusing on the NASDAQ, the more racy of the stock index.
Okay, so the NASDAQ down 92% from its all-time high is what you're forecasting.
And that would be around 1,300.
Okay, and how exactly do you see this playing out? I know you said it's in waves, and I know you said you're looking for confirmation. So what would that confirmation be, and how do you see this phenomenal crash then playing out?
Yeah. Okay, yeah. So we had that first crash down 34%, okay? And then it bounced substantially, and it's gone back and forth. It went to make one more new low, down 38%, the NASDAQ. Now it's back up towards 11,000. And it has to break that last low, 10,088. I think in mid-August, we already started the next wave down. So that's the second point real quick. When you see a major bull market or the beginning of a new major bear market, like 1929 to 32 or 1972 to 75, there will be 3 waves up or down. And now we're talking down. So again, first wave bottom in June. Bounces sideways since. We're in the third wave down now, but it has to break to a new low to say, hey, it really is that third wave, and we're going to go a lot lower, okay? And so 10,088 is the line in the sand on the NASDAQ there. And so when we break that, it's going to go down a lot more. Next thing you know, we're going to be down at the 2020s. Now, this is just going back to the COVID lows of about 66, 67, about 6,700 on the NASDAQ. That's my next target. So that's the next wave, the middle wave. And then that'll bounce, later in the year. And then we'll have one final wave down, the third wave down, and that'll cause a bottom. And that's, again, if I had to predict today, it'd be mid to late 2024. So it takes 3 waves for a major movement to happen. We've only seen the first one, and it looks like to me we're starting in the next wave, the middle wave. But that middle wave will not be confirmed until we make a new low over the 10,088 low, which was actually in August of 2022 in the NASDAQ. So again, the time to get out is on the bounce. If you wait until we break that 10,088, it'll be down fast from there. Okay, next thing you know, we'll be at 6,700. And then you're down 55, 60%, and you're like, oh my God, I've lost my life savings. And that's not even the bottom.
So, Harry, but you do think the bottom, the worst of it, will happen by late 2024?
Yeah, if I had to guess the day, I'd say July 2024, and at the latest, the end of 2024, yes.
So is there anything that can derail this or significantly delay this crash? Is there any kind of Fed intervention that can prevent the crash? Perhaps a diplomatic resolution to the Russian-Ukraine war that opens up supply chains, changes sentiment, a geopolitical development?
I don't care about the Russian thing. That's nothing here. It's all the Fed. You got to realize the bubble, the first bubble that happened in 95 to early 2000, that was what I call a natural bubble, like 25 to 29. That the baby boom was spinning like crazy. Inflation was coming down from their strong productivity. Everything was going right. Just like 25 to 29, that was 95 to 2000. That was a natural bubble with little government stimulus, okay? They're making things easy, but it was the crash, that came in the next top at 2007 and the 2008 downturn, which is I've been forecasting since the 80s, early 80s, that we would see a top in late 2007 and baby boom spending, and then we go into a long-term weak period from 2008 to 22 or 23. So we go into that now really weak period, and we have a serious recession, and that's when the Federal Reserve and central banks just said, Mario Draghi says, I will print unlimited amount of money. He's telling short sellers, don't dare short this market. I will blow you out of the water. Now that is horrible fiscal management, okay? To be playing that type of battle with short sellers and markets, okay? So the Fed is the one that so the boom from 2009 to late 2021 in stocks was 120% artificial, not fundamental strength, just them stimulating more and more and more and more to keep the stock market going up. So at least the wealth effect made the top 20% of people, who spend half the money, by the way, feel good enough to keep the economy going pretty good, okay? And now that started to fail. Why? They overstimulated, as I said, in COVID, which was a natural thing. Why would you overstimulate? Why would anybody feel like there's something wrong with the economy if we slowed because a lot of people got sick in a short-term thing, okay? That happened in 1918 to 20 as well. So that's what happened. They overreacted to that. Now they have to tighten. And I'm telling you, this tightening is already slowing the stock market more, and it's going to slow the economy. I think within the next few months, we're going to be in a real recession. And then it gets kind of too late. If the stock market, by the time the Fed realizes, now we over tightened after overstimulating, and we gotta stimulate again, they're not gonna have much credibility. People will say, like, well, you did that in time before. Here's how we got in this mess. So I think the Fed loses credibility here. And so the thing to watch for, that's why I'm telling you, the best signal I can give you to get on alert, first of all, why not lighten up now in this nice hefty bounce? Since we've now finally shown that the economy can go down despite all this endless stimulus and endless bubble. But that 10,088 is the line in the sand at this point. We break that convincingly, it's going to be hard to turn around. Investors are going to turn around from, oh my gosh, you just buy the dips, buy the dips, buy the dips. They've been trained that since 2009 and even longer, but especially then, it's going to be like, oh my gosh, protect yourself. Once you get people that scared, you can't bring this back with any amount of stimulus. So frankly, the Fed caused this last bubble totally, and now they're forced to tighten from overdoing it. And I don't see any way to prevent it from here once it gets a little worse and people see, oh my gosh, yes.
Okay, so the confirmation, if we break 10,088 on the NASDAQ, then all hell breaks loose.
Yeah, 10,088 on the NASDAQ.
Look, Harry, definitely hear your point about the Fed being way behind the curve here, about the Fed overstimulating, about there being a massive disconnect between Wall Street and Main Street, that the markets don't necessarily reflect the real economy. That has been the case for a very long time now.
Very long.
And so it begs the question, why couldn't they just continue to kick this can down the road? Because the markets want that. The markets want a Fed pivot or a Fed pause. They want to continue playing this game, even if it is divorced from fundamentals, as you say it is. So why would that cycle change? So why different now?
Here's what I compare this to, Michelle, and it's extremely simple. This is financial drugs. If I could be the most depressed in my whole life, my dog died, I lost my wife, and can I feel good in the moment? Heroin, cocaine, crack, alcohol. There's so many drugs you can take to make you feel good for some period of time, but when they wear off, then you get a hangover and you feel worse. This is the same exact thing. It's different when you're booming because a generation is growing up, getting more productive, earning more money, spending more money, bringing inflation down with their productivity, because as people get older up to the point, they do get smarter and better workers. It's another thing when it's growing only because the government keeps printing more and more and more money. That is taking a financial drug, a toxic financial drug, which when it finally goes down and fails, you have a hangover. So we're going into a hangover. And then again, once it gets to a certain point, it's hard to revive it because people were skeptical at first when okay, every time we slow down, we just print money. Every time there's a stock, print money. But the government did it long enough that people are like, well, it's working. Well, it's not working now, and it's backfiring on the central banks. And again, there's no way that Jerome Powell, after finally tightening way too late, after overstimulating, as we've been talking about, if he turned around and pivoted on this, it would look really ridiculous that he tightens a little bit and has to turn around and go back to easing. That would prove how weak the economy is, and it would make the Fed look reckless.
What about a pause? What about a pause?
Well, that would be the smart thing to do. That'd be the smart, just say, okay, we tightened, but it seems like the economy's reacting a little too much. That would be the smartest thing to do, is pause. The markets would like that. I still think the economy is now at the point where it's going to keep weakening now that it's that.
So even a Fed pause.
Let me just finish. It's not tightening. This economy has been going only on escalating stimulus. You don't have to tighten to end this bubble. All you have to do is stop feeding the bubble. So even if they pause, we're not going to go back to normal. The stock market is going to be on the weak side, but a pause would be the smartest policy right now, because coming back from tightening and going to easing would really look really bad for the Fed.
All right. Well, I mean, the Fed's arguably had a pretty bad look the last couple of years. Certainly that inflation transitory call, not really enforcing any kind of sense of credibility there. Harry, I get your point about the U.S. economy being overstimulated on drugs, on crack, requiring a major detox. And you've long said that recessions are not necessarily a bad thing because
they're the best thing. Recessions are more important than booms. I was a turnaround management early in my career. I went from Bain & Company turning around Fortune 100 companies to doing the same thing with new ventures in California. It is only in crises that people really innovate. We always have crises. Why did God create thunderstorms and lightning and all this stuff? If we're not stimulated by adversity now and then, or get in a crisis, we don't wake up and really innovate and re-look at things. We would rather just float down the river and hope that everything rains on our head and everything comes easy. So these crises are part. You can't have booms without busts.
Right.
We cannot be awake without sleeping to restore. So this is just a natural cycle. We have now taken an economy that has boomed so long, it needs a rest. We need to flush out bad debts. You know how many the biggest growth industry is zombie companies that are barely alive only by not paying their debt service. But even without paying their debt service, they're just barely alive. So that's bad. Economy, free market capitalism works because you let people pursue success, but you also flush out the failures. George Gilder is my favorite economist because he says failure is the secret to capitalism. State-run companies never flush out their own state-owned industries and let them get fatter and fatter and less efficient until they fail. Free market capitalism relies on failure as well as success. So we're not allowing the failure, and we haven't since 2008.
But you're saying that failure is inevitable now. The recession is coming. No. It's not a bad thing. It's going to clear.
We have record debt and debt ratio.
Right.
Every time we have record numbers.
So what happens after the carnage?
You got to flush these debt and zombie companies out, or you're moving forward like an overweight person, going slower and slower and slower, even if the fundamentals turn in your favor when the millennials will in a few years.
Okay, so I get that. It's not necessarily a bad thing. So give me the positive picture of what things look like after the carnage. What do things look like for the US economy in 2025 then, give or take, seeing as you called the bottom in late 2024?
Okay, so what happens, and this is already set in the cards, we just need to clear the decks to optimize it. The millennial generation has their spending wave, like the baby boomers did from 83 to 2007, the Bob Hope generation before them, 42 to 1968. Well, this generation is shorter and smaller relatively. Their boom is 2025 through 2037. So we will go in the US into another boom. Now, of course, who's going to be booming more than us, who has many more people and many more younger people? It's all of Asia, okay? Not Japan, not China. China already is peaking in their demographics currently right now, actually already, and will continue. China's going to go, now listen to this, by 2100 from 4.2, I'm sorry, from 1.4 billion people down to 770 million. Okay, they're going to lose hundreds of millions of people. They're going to be the first emerging country to peak in demographic trends and go down, down, down. Developed countries all peaked decades ago, and one after another has been slowing down. But China's going to slow down more than any country in history. So again, this is another. So we come out of this. China's not going to lead coming out of this like they did. It's going to be Southeast Asia and all those countries. And India is the next super large country that can urbanize and grow at 1% a year, urbanization and go up. So it's going to be the U.S. will do best in that boom I'm talking about than Europe, because we have stronger demographics, even though they're weakening. And India and Southeast Asia will do much better than China. China will never come out of this the same, because here's the secret to China. They so overbuilt their economy. I know people have heard about it. 22%, now that was a couple of years ago, it's probably higher. 22% of their homes and offices are empty. They just build stuff to stimulate the economy. They don't print money, they print condos. That's my word for China. That's how they've been stimulated. So China comes back out, they're going to never need to build a new house or office building ever again in a country that's already peaked in its population and its whole spending wave, and is going to do nothing but go down for decades. I mean, for as far as the eye can see, China is done. Not only are they done, they over-leveraged with all these empty housing. They've so over-leveraged that even the 20% that have yet to move into cities, they already have enough to accommodate and no need to build for. So China will never see what it's seen again, and the boom will continue to shift as it has for hundreds of years, east to west. So it'll go to Southeast Asia and India.
I mean, it's a very, very big point you're making there, that India will be the next China, that the demographic...
With more people, and it's higher of potential GDP per capita.
So what does this mean for this idea of China being a dominant player in the new world order, as so many are suggesting it will be and has already become?
It's already seen it. You've already seen the best of China because they cheated and overdid it. It could have been another decade or so, but they already overbuilt for the future. So China will never be the growth engine it was in the last 30, 40 years. And that will come from Southeast Asia and India. And India, after I'm dead and you're dead, after me, China will be the largest economy. One day, around the 2050s or 60s, India will be the largest economy in the world. And the U.S. will still probably be a little bigger than China.
So you're saying that China is going to lose almost half of its population by what, 2100? The year 2100?
I think about a third or something. It's going to go, from 1.4 down to about, let's say, 0.8. So they're going to lose about 40% of the population. I mean, that's never happened before, Michelle. Is that a one-child policy consequence? The more affluent people get, okay, the less children they have, okay? So that started in the developed countries. China and Japan were the first Asian countries to accelerate, especially Japan first and South Korea. And as soon as they got rich, they just stopped having kids. The birth rate is 1.3 in China, 1.2 in Japan. 2.2 is to just keep your population at the same level. These countries Japan is collapsing before our eyes, has been for a couple of decades. China is going to collapse just as fast over a longer period of time. This has never happened in history that we've gotten so affluent that we stop having kids and you can't grow down the road.
Well, I mean, China also had the one-child policy enacted for the longest time.
And you know what? They took it away, Michelle.
Yeah,
they lifted that. You know how many babies they had in response to that? Less.
Yeah.
Once you've had only one kid, you realize, oh man, this is a good deal. 2 or 3 are just 2 to 3 times more expensive. So it's hard to get somebody that's done that. The lifting the child restriction in China did no good whatsoever. Why? Because they've gotten more affluent and they're aging. They're the fastest aging emerging country in the world, and aging leads to slower growth. So aging means more and more older people. More and more older people means less births. So it's a reinforcing cycle that gets worse and worse. And again, never happened globally in history on any large scale. The countries got so affluent that they aged rapidly and then declined because of aging.
Right. All right. But you say it's not in your lifetime. It's not in my lifetime. Let's focus on our current lifetimes and what we can do. And I want to bring the conversation back to what investors can do, because usually in times of crisis and rising inflation, we typically see gold as a safe haven. Now, we have seen gold rally a little this year. It's broken 1900 recently. But you write in your recent newsletter, and it's a very colorful quote, that gold will go running to mommy with everything else before this crash is over. And unlike commodities that have already crashed, this is going to be more dramatic for gold, likely into late 2023 or later. So gold is going to be running to mommy, and gold has more downside than most commodities that have already crashed a lot.
Yeah, only because commodities have already largely crashed and gold has held up. Now, this is what I'm saying is exactly what happened in the 2007-8 crisis, okay? When stocks peaked in October 2007 and started to go down, gold held up and actually drifted up. Gold was seeing itself, okay, we'll be the safe haven when things go down. We're going into a recession. Well, gold then crashed in the second half of 2008. Gold followed commodities and stocks down and crashed 45% in just a matter of 3 or 4 months. So gold was held up the longest, just like now. It's flat to up, but it went down not as much. It still didn't go down as much as other commodities, still didn't go down as much as stocks, okay? But gold ended up crashing and crashed rapidly. So gold is not the safe haven. I'll tell you what the safe haven is. Anybody looks at it, was 100% crystal clear. The highest quality long-term bonds in the world, U.S. Treasury bonds. 30-year Treasury bonds would have been the best thing to hold in the 2008 crash. They would the TLT, which is an average of 10 and 30, went up 45%, precisely when stocks and gold and everything crashed together in the second half of 2008. The 30-year would have gone up more than that. I'm predicting that the bonds recently will double. The TLT could double from its recent bottom at 92 in going to 186 in the next year or two. The safest bonds in the world are actually what appreciate the most when a financial asset bubble goes down and all other financial assets go down, leaving the safe haven. And again, same thing. Gold might be the last one to go down, but it'll go down in the end, just like it did before. I'm predicting gold goes down to 900 to 1,000. That will be a lot less than commodities again, but that's still a 45% fall from here. So anybody thinks gold's going to protect you here, good luck.
So gold going to 900 or 1,000 again by this late 2024, July 2024. Yeah,
and it'll tend to bottom earlier. Yeah, it may bottom with or earlier than stocks, but yeah.
But big picture, beyond 2024, assuming gold does follow this pattern, what are your thoughts more long-term on gold? Because we're seeing record central bank purchases of gold. We've got the BRICS saying that they're exploring the possibility of a new currency, potentially pegged to gold, as well as a basket of other commodities. Russia and Iran are reportedly working together to launch some kind of stable coin pegged to gold, backed by gold to a degree, that could replace the US dollar for payments in international trade. The signs are pointing towards de-dollarization, given how the dollar has been weaponized around the world. And the other signs are pointing for gold to come back and take its spot as a reserve currency, as a peg to a new form of reserve currency. What's your thoughts on that?
Okay, that is not what I see. I see gold turning around and doing. I think gold could go to 3,000 to 4,000 in the next boom. You know my number one reason? Yeah, I have traveled, especially to India. It's the second country I've traveled to the most outside of Australia. The people who love gold the most in the world, Chinese, but Indians even more. If India is the next big thing, gold is going to boom because Indians buy and use gold both for security and jewelry and everything else. Okay, Indians are poor, and the best way to show a little wealth is wear gold wherever you can, and they wear gold in places we wouldn't even think of. Okay, so gold, for fundamental reasons, will do well and go up in that next boom. Okay, but the safe haven, I think, what will become the whole purpose of the crypto, okay, in Bitcoin. Bitcoin has the potential, from my view, and it's got to be much more valuable than that, to become the digital gold. And they call it that. A lot of people call it the digital gold. Bitcoin would have to be $500,000 or more, but at that point, it starts to be worth more than all the gold in the world, and it's more expandable than gold. The problem with gold is gold supply is running at about 1% and falling a year, and the world economy is growing at 5 to 6% typically. So gold was a good standard for money in the past. It doesn't fit a digital world, and it doesn't fit a faster and larger growing global world. So I see crypto, Bitcoin, slowly over the next couple of decades becoming that digital gold, and gold growing for better reasons, fundamental demand by emerging countries they may never get as rich as us, and they will not. I can project any country, okay? India might get up to 24,000 GDP per capita, still a third of the US, but that is 3-4 times what they are now. It's a huge boom. Those people will be driving the demand for all types of commodities, but particularly gold. So I would be a buyer of gold, and it's a great diversifier in a portfolio, just not when it's going down. I would buy gold myself a few years from now if it got down that 900,000 range, looking for it to go to 3,000 to 5,000. But I still say the best stocks and stock markets will do better than that in the next.
Okay, so you see gold rallying to about 3,000, 4,000 after this giant collapse, but mostly due to fundamental reasons and demand for it in growing economies like India.
But for money in the future,
right?
Gold,
so you don't see gold playing a major role in any kind of global monetary reset. You do see Bitcoin playing that huge role. You have in the past said that you do expect Bitcoin to also not weather this crash, that it's going to go down the most.
It's the biggest bubble, so it's bubbled the most, and it already has gone down. It's gone from 69 to 16. Now it's bounced to 21. My prediction, and people I know a lot of crypto people down here in Puerto Rico. They really they think it's going to 10 to 11. The smartest crypto people. I think it's going to 32.50. That is simply the last low before the last bubble. Up to it went from 32.50 in a year and a half to 69. I think it goes back to 32.50, and then we start a longer term boom for crypto. And I think I see it as the next big thing. I didn't get it till a guy speaking in my own conference in a few years said it, Mark Yusko. He defined the crypto thing as the digitization of all financial assets and money. Digitization makes, just like we did with the internet and information, we digitized that and made it available, easily accessible. There's $600 trillion today in financial assets. I'm the only one that knows that number. Ask somebody how many financial assets there are in the world, and you won't get an answer. 600 trillion, we're almost there, okay? Digitizing and making that easier to trade and pass around and make more efficient, that is a huge thing. So that's what the crypto thing really is. It's not about having 40,000 coins. All crypto's been so far is new companies can issue a coin, instead of an IPO at a tiny price. It's a cheap IPO. And you know what that means? We got a bunch of BS companies out there with cheap IPOs that are going to have to fail. The real purpose of crypto is basically restructuring the entire financial asset. That's the biggest financial number in the world. Global GDP is 100 trillion roughly. Financial assets, the biggest multiplier, $600 trillion. That's why I'm bullish on Bitcoin and crypto. But baby bubble in the early stages, just like the dot-coms 22 years before them. So I also see crypto like the dot-com revolution, online retailing, not just internet, but online retailing and sales and business. That was a big bubble and a big burst, 2000 and 2002 burst. This is the bubble burst of the crypto bubble. Crypto is simply the biggest bubble of bubbles here. And so it'll crash the most. 3250 will be down 95, 96% for Bitcoin. And then it will lead the boom. So if I had to buy something at the bottom, I wouldn't buy IBM, or the NASDAQ even. I would buy Bitcoin and Ethereum, the leading surviving cryptos out of many baloney companies.
Right. Well, according Mark Yusko, we've had the pleasure of having him on Kitco News. He does make a very compelling case for exactly what you're saying. But Mark is also very concerned about what we can expect from regulation, especially in the fallout of this FTX collapse, and that really sort of clearing the ground for regulators to march in with indignation. Also, a concern of Mark Yusko's and others is this idea of a central bank digital currency, CBDCs, and what that means for Bitcoin and cryptocurrencies. Do you see those coexisting? Does that derail your thesis here if regulators come in with more ferocity if central bank digital currencies?
But what governments do is they always overborrow, overspend, overprint money. That's the whole point of crypto. If you have a global standard that is not manipulatable, Bitcoin is fixed. That's the secret to it, okay? That was the genius of that guy, Satoshi or whatever, that came up with this thing. Something needs to be more fixed that could be a real standard. If you can print a standard, it's not a standard if you can manipulate it. That's why the dollar can't be the currency, especially as we move towards Asia dominance and stuff. That's why I see Bitcoin is the only thing that could be a new effective standard. And it would have to be worth $500,000 to $1 million per coin to be there.
I hear that. The Bitcoin maxi certainly agree. That is part of the vision of Satoshi Nakamoto, to have something that cannot be manipulated like fiat currency is. But because it is such a threat to central banks' ability to create money out of thin air, there is concern that regulators will...
The central banks that do nothing but manipulate and cheap and print money out of thin air to grow, or something that could be a new emerging technology that's already...
So you're not concerned by regulation?
I'm betting on Bitcoin winning, not the damn central banks. I want the central banks to fail so bad they go back to just making enough currency and money available and quit trying to run the economy from the top down, as if any of these people who never had sex or run a business know anything about the economy, and they don't. Find me one Federal Reserve chairman that's ever run a business. I'll leave out the sex part.
I can't speak to the sex part for sure there, Harry. And you do make a case. In fact, many of the politicians that are running our economy have never actually had real world experience. I believe, I know Stephen Moore's company did a study on that, and it was quite eye-opening to see the resumes of the people that were entrusting our economy to there. I believe
they've had a lot of training in theory, okay?
Okay.
They have high education, just not in things. I took economics, my first 3 courses, and I was interested in economics from the beginning. I took 3 courses in economics. Said, this is useless stuff. It's all theory. It's all vague. I started taking real stuff like finance and accounting and marketing and management.
Okay, but let's go back to the sex idea, Harry. And I mean that in the sense of population growth and demographics, because
that drives the economy.
Well, there on many fronts. But most of your work, if not all of it, deals with demographics. And you forecast that the U.S. economy will continue to decline as emerging markets like India, as we've just discussed, have the potential to become economic superpowers, right? So if you're a young American today, between 18 and 34. Is it wise to stay in the United States? Should one perhaps look at laying down roots elsewhere? Move to another country, another continent?
Well, if you don't want to learn to speak Hindi or some other foreign language, no, okay. First of all, the United States is still the largest and strongest country in the maturing, developed world, okay? And one of the things that I expect to happen, again, mostly after I die, is that we've gone from living to 60s on average to 80. Okay, what happens when we live to be 100, 120? What happens when you can have your first family, then take a vacation, a long 10-year vacation, and go around and party and see the world, and then have a second family? Okay, I mean, so a lot of things could change long term, but it's not just our better technologies and living a little longer. The fact that we have lived longer has been a big factor in why more money was made, more progress in the 1900s, the last century, than all of history put together. So this aging thing is an important thing, okay? So, but all developed countries right now are aging too fast and aging by means of not having kids. So we have to have a way to find more kids. Some countries are doing well because they're attracting high immigration. Australia's not having, more babies than us. They're attracting high income immigrants from growing Asia. So you either have to, as a country, you have to keep birth rates up or you have to attract immigrants from but the only way the world grows is if the people in it get more rich, which the emerging countries are, or if you have more babies. So we have to do something to reverse this fact that, just because we got affluent, it means we don't want to have kids because kids are a pain in the ass and they crimp our standard of living, okay? And in fact, people used to have 4 or 5 kids just so 2 to 3 would survive in the good old days when child deaths were much higher. So this is a big change in the world, births and stuff and immigration, aging. And right now people are fighting over the best immigrants in the world, but at some point, countries have to figure a way to incentivize their people or encourage their people to have more kids. You ultimately have to have more kids for the world to grow.
Yeah, you and Elon Musk are certainly touting that philosophy. Pronatalism, I believe it's called. Let's bring it back to where we are right now. And that is an investor looking to position himself or herself for this crash that you're saying we're only entering the third wave of. What should an investor do? You've touched on treasuries. What else?
Well, see, the problem is when you have a bubble of this proportion and an everything bubble. You got to remember, when stocks first peaked in 2000, real estate hadn't bubbled yet. Real estate bubbled because stock peaked, and all that money went running into real estate until real estate bubbled. Now everything's bubbled. So everything comes down. There's not much place to hide. So the best quality bonds you can buy, the 30-year Treasury is the best of the U.S. because we're still the leading. We're the best house in a bad neighborhood. We're not perfect. We have too much debt. Our government has too much debt. But you can also AAA, AA, the highest quality corporate bonds. Okay, that's another thing. And you can buy the bonds of other strong countries like maybe Australia, Sweden, Norway. Countries that have better demographics hold up better. But even those, I'm telling you, the U.S. dollar trumped in 2008. It'll trump ahead and knock down some of those currencies. So it's more limited in the downturn. You have to get safe. And the super safest thing is just being cash, but cash makes you nothing. These high quality bonds are where the money really runs because most people aren't going to go to cash. That's where it runs the most when these other financial assets, real estate, stocks go down. So 10 and 30-year U.S. Treasury bonds are the best bet. You can, ZROZ, Z-R-O-Z, is an ETF. You can buy like this, sell like this, 25-year average. That's my favorite. TMF is triple on the TLT. TLT is 20-year average. So the ZROZ will go up about 50, 60% more than TLT, the 20-year average Treasury bonds between 10 and 30. TMF is triple the TLT. So if you want to just put a little leverage in your portfolio and have a lot of cash on the side, or you want to hedge your stocks, you could buy TMF, which is triple leverage. And if your stocks go down, it means the economy's slowing, and your treasury bonds and TMF and all these other things go up. So that's the play. High quality bonds, corporate, but still the U.S. treasuries are the best, and the dollar holds up the best. You have currency risk when you buy overseas. In the next boom, you want to get in the best sectors. You want to get in Asia, Southeast Asia, and India. Funds on that. I'm racking up a whole list of funds now in emerging markets, India and Southeast Asia, because China is not going to come out of this strong for reasons I said earlier. So and back in stocks and in the stock index, I'll always want to buy in the U.S. will be the NASDAQ, because we're still the technological leaders, and the NASDAQ is technology favoring. So the NASDAQ would be the number one index I'd be buying in the U.S. at the bottom, say a year and a half or two from now, and I'd be buying heavily Asian stock.
But if you have any NASDAQ exposure at the moment, you're saying get out.
Oh, yeah. This bounce is a gift, because the NASDAQ is led this so far, along with the Russell 2000, the small caps. In the end, the S&P will largely catch up to those. Remember I said before, I'd say that at the bottom, my projections, and again, going back to the same place, the 2009 lows, the S&P be down 86%, NASDAQ 92%, and the Russell 2000 about 92%. Okay, so but earlier in the process, the NASDAQ and the Russell 2000 go down the fastest, and the S&P 500 trails. So right now, I'd want to be short the NASDAQ. You can do that. The QQQ is short as PSQ. You want to be triple short to do a little bit to hedge your portfolio. SQQQ is the best way to short the market with leverage. It's 3 times short the PSQ, which is 1 time short the QQQ, which is the top 100 NASDAQ.
Shorting with leverage, that can be a very dangerous game to play, Harry.
Yes. Again, what I do, I use SQQ as a hedge. So I can put a little money in SQQ and still leave a lot of cash open to take advantage of opportunities in a downturn, because that's another thing. I mean, the house down the street from you might go into default and foreclosure, and you pick it up for 50 cents on the dollar, okay? So the SQQ is a way to hedge or to leverage is something. It's the best thing, yes. And most people are going to short. I'd rather if you just want to short the stock market, the benefit of the downturn, I'd recommend being PSQ, just 1 time short the NASDAQ 100.
All right, Harry, thank you as always for being very specific, very deliberate, very bold in your predictions, and always putting your neck out there for the benefit of our viewers. So thank you so much.
More information, real easy, harrydent.com. I have a paid newsletter, but I also have a free newsletter. You get an article every week from Rodney Johnson, my partner, and from me. And you can get on that for free at harrydent.com and learn more about us until you're convinced to get on our real newsletter.
All right. Well, we like to give our viewers the option of the information. And you've certainly given us a lot of food for thought, as usual. Harry, thank you so much for joining us. Really appreciate it. Harry Dent. All right. Thank you. And thank you for watching Kitco News. I'm Michelle Makori. As always, keep it right here.